All right, let's jump right into this explainer. Today, we're looking at a company that is honestly one of the most baffling contradictions in the entire market right now. We're talking about Murphy Oil, trading under the ticker symbol MUR. It's an independent energy company operating out of the US and Canada with some massive new offshore developments. But right now, if you look under the hood, the data is sending completely mixed signals. It's a stock that has Wall Street buzzing, yet the legendary investing frameworks can't seem to agree on it at all.
I mean, just look at the deep polarization around this $5.5 billion company. It's literally dividing the greatest investing minds in history. Think about it. How is it mathematically possible that Warren Buffett's strict value metrics give this stock a big fat F, but Peter Lynch's framework gives it a solid pass? To figure out if Murphy Oil is a hidden gem or a dangerous value trap, we really need to pull back the curtain on the numbers that the mainstream financial media is kind of just ignoring.
Let's kick things off with the big, flashy headline. On one hand, Murphy Oil recently completely smashed their Q2 earnings by a staggering 474% year over year. That is huge. They drove total revenue to $928 million, blowing past estimates across the board. In a sector as volatile as oil and gas, printing an earnings beat of nearly 500%, well, that's the kind of momentum that makes everyone sit up and pay attention. But on the flip side, and guys, this is where the paradox really begins. The stock is currently trading at a trailing PE ratio of 64 times earnings. Just let that sink in for a second. 64. For an oil and gas producer where earnings can wildly swing based on commodity prices, that multiple is absolutely astronomical, especially when you consider that the industry average is just sitting around 11. Wall Street is basically pricing in absolute perfection here, and if oil slips even a little bit, that lofty valuation is at risk of a major collapse.
So let's move into Section 1, the prosecution. We're going to break down 7 alarming red flags building the bear case.
Look, when corporate insiders are cashing out while revenue is actually shrinking over a 5-year period, you really have to stop and question if the stock is already fully valued. Think about these two things together. First, the stock goes on a massive 52% run, and the people who know the business best, the insiders, start dumping their shares. Second, despite that recent quarterly pop we talked about, the 5-year annualized revenue growth is actually negative 0.4%. Sure, they're projecting double-digit growth moving forward, but relying on hope rather than historical data, that's always a risky bet. And here is our next red flag. Analysts just quietly slashed their 2026 earnings per share forecast by 15%. Right after those blowout Q2 results, Wall Street completely revised the future EPS from $3.65 down to $3.10. The takeaway here? Even though revenue estimates ticked up a bit, profits are getting seriously squeezed. It's a massive, flashing warning sign that operational costs are rising way faster than revenues. Furthermore, if you actually dig into the balance sheet, you'll see that those recent headline profits were padded by $22 million in unusual one-time items. In investing, this is what we call a deterioration in earnings quality. Without those non-recurring gains, the actual day-to-day operating business looks noticeably weaker. It's absolutely vital to always strip out those one-offs so we can see the true cash-generating power of the core business. So, bringing this to the deep value investors, the crucial point is right here. Both Benjamin Graham and Warren Buffett's frameworks outright reject this stock. Graham's criteria give it a 37 out of 100, simply because that crazy 64x PE completely destroys any margin of safety, and Buffett's framework scores it even lower, a 33 out of 100. Why? Well, because Murphy Oil's return on invested capital, which is how efficiently they use cash to generate actual profit, is a measly 1.6%. Buffett usually demands 15% or higher. From a strict historical value perspective, this company just completely fails to deliver the high return economics those legends demand.
But wait, let's flip the script. Section 2, the defense. We're looking at 7 massive green flags.
Because here's the massive catalyst that everyone seems to be sleeping on, the Booble discovery off the coast of Côte d'Ivoire. We aren't talking about a minor little find here. We are looking at an estimated 200 to 300 million barrels of oil equivalent in this field. They've actually hit oil in multiple reservoirs. For a $5.5 billion company, a find of that magnitude, it could fundamentally alter the entire trajectory of their future cash flows. It's still early stage for sure, but this is a potential company-making asset. And when you combine that future potential with their current execution, you see an operation firing on absolutely all cylinders. Remember that 474% EPS beat we mentioned earlier? That means earnings jumped from 26 cents all the way to $1.55 per share.
They pulled this off through just incredible extraction efficiency at their key North American drilling sites. They pushed production to 169,000 barrels a day, completely crushing the midpoint of their own guidance. So they aren't just finding new oil, they are flawlessly extracting the reserves they already have. Plus, despite operating in a highly capital-intensive industry, they printed $110 million in positive free cash flow in Q2 alone. I mean, exploring for oil and running rigs is incredibly expensive, so to generate that kind of cash while simultaneously growing your production, that is essentially the golden ticket in the energy sector.
Unlike a lot of their competitors who are practically drowning in debt, Murphy boasts an ultra-strong balance sheet. It's a true financial fortress. We're talking pristine leverage below 1.0x and massive total liquidity sitting at $2.5 billion. But honestly, here is the absolute most exciting part for energy bulls. They are deliberately 100% unhedged. Most companies lock in prices with hedges, which kind of caps their upside. Not Murphy. They are letting it ride. When realized prices cross $90 a barrel, Murphy captures every single penny of that upside.
Which perfectly explains why the Peter Lynch framework gives it a passing grade. Unlike Buffett or Graham, Lynch actually loves this kind of setup. He sees that 22% plus EPS growth, the highly manageable debt, and he scores it a 62 out of 100. Now, he does acknowledge that the PEG ratio, comparing price to expected earnings growth, is slightly stretched at 2.79. So, okay, it's not a screaming bargain, but that growth narrative absolutely earns it a passing grade in his book. All right, bringing us to Section 3, the jury. Let's test these guru frameworks against each other. You can see the divide here is just perfectly split. Guru Focus gives it a narrow moat, meaning it beats most peers but maybe lacks a forever hold advantage. Then you have your strict value investors, like Graham and Buffett, demanding a hard pass because of that crazy 64x PE and the low return on invested capital. And yet, growth-tolerant frameworks, like Lynch's, see a super compelling narrative where all that operational execution outshines the current price tag. So let's wrap this up in Section 4, the verdict. Is this a value trap or a hidden gem? If you're the type of investor who needs a safe margin of safety, the bear case on the left is absolutely going to scare you away. An inflated 64x valuation, insiders cashing out, and a historically shrinking top line? Yeah, that's a terrifying combination for conservative investors. But if you look over to the right, the bull case offers an unhedged fortress of a balance sheet, flawless quarter-over-quarter execution, and a massive offshore discovery that could be a total, absolute game changer. Ultimately, what this explainer reveals is that Murphy Oil is not a deep value stock at all. It just completely fails those fundamental tests. Rather, this is entirely a speculative growth play. It's an investment strategy that really requires you to focus on massive future expansion catalysts, like that unhedged commodity exposure and the Booble discovery, rather than seeking comfort in today's fundamental valuation. So I'm going to leave you with this final thought. Knowing the target entry point for a truly improved margin of safety is below $33 a share, are you willing to bet on the incredible potential of that offshore booble discovery? Or is that extreme 64 times valuation just way too rich for your blood? Honestly, this paradox is exactly what makes the market so fascinating. If you enjoyed this deep dive explainer and want us to keep following the YouTube guidelines perfectly to bring you all the points, be sure to hit that subscribe button, smash the like, and let us know your verdict down in the comments. Are you buying or are you waiting? Thanks so much for joining us for this explainer, and we will see you on the next one.